Welcome to the Texas Mortgage Bankers Association's Education Webinar Series, a part of the Education and Endowment Committee led this year by co-chairs Hannah Barton and Stephen Bertrand. I'm Stephen Bertrand, and I'll be helping facilitate today's webinar titled Economic Insights, a panel discussion on the future of mortgage lending. TMBA invites you to attend its education symposium this November 4th and 5th at the Hilton Dallas Lincoln Center Hotel. The committee is crafting sessions with industry leaders and experts that will give you the latest news and trends in the mortgage industry. There's still time to take advantage of the early bird registration prices. Please visit texasmba.org for more information. We'd love to hear from you during our webinar today. Please feel free to ask questions throughout the webinar using the Teams Q&A. Now I'd like to introduce today's moderator, Scott Holtz. Scott is a regional sales director for Mortgage Capital Trading. Before joining MCT in 2022, he spent most of his career based in the Dallas area as a correspondent sales executive, including 8 years at Chase, 11 years at Countrywide, and 11 years at Lomas and Nettleton. Okay, let's get started. Scott, the presentation is all yours.
Thanks, Stephen. Thanks again for having me on. I'm going to introduce our two panelists, and I'm just going to read their bios so I don't screw them up too badly. So bear with me here. Joel Kahn serves as Vice President, Deputy Chief Economist for the Mortgage Bankers Association. In this role, he is responsible for MBA's macroeconomic and housing market forecast and oversees the production of MBA's industry surveys, including the weekly mortgage application survey, builder application survey, and mortgage credit availability index, three of the association's high-profile surveys. Mr. Kahn represents regularly on the economy and the housing market at MBA and industry events, and is interviewed and quoted frequently in national, local, and industry media outlets. Prior to joining the MBA, he worked for Ernst & Young's Quantitative Economics and Statistics Group. He holds a Bachelor of Science in Economics and Statistics from the University of Michigan. Thanks so much for being on, Joel. And Dr. Daniel Oney is the Director of Research at the Texas Real Estate Research Center, where he joined in 2022. He specializes in building forecasting and decision models to help public and private lenders make better economic and fiscal choices. Before joining the center, Daniel was managing director in Newmark's Global Corporate Services Division, where he supported clients with site selection, labor analysis, and development strategy. Daniel was economic research manager for the city of Dallas and senior economist at the Virginia General Assembly. He holds an MPA and PhD degrees from the University of Texas at Dallas. So thank you both. Everyone probably wants to know what I'm doing on a webinar with a PhD and an economist, but we'll leave that alone for now. So I thought we would just start by taking your pulse on, just sort of the overall national economic view right now. Seems like that there's sort of a mixed bag of statistics that you could interpret different ways. The GDP's been great, stock market's been great, but we've had inflation, we've had somewhat slowing job numbers. You have the election going on where the two parties are offering different views of what's going on. So just wanted to step back and hear from you guys what you think the kind of overall health is of the economy. Joel, you want to go first?
Yeah, sure. Thanks. And again, thanks for having me. And definitely delighted to have this conversation with you, Scott, and Daniel, too. So, starting with our view of the macro picture, I think, as you said, 24, even as we were in the closing months, seems to be a pretty strong year by historical standards. I think a lot of us were concerned all the way back in 22 when the Fed started to raise rates, how resilient would the economy be over the course of the policy tightening cycle. But as you know, the Fed funds rate went from 0 to 5.5%. And recently, yes, they did levy sort of a 50 bip cut, but we're still running at pretty strong economic growth overall. And just this morning, we got a pretty strong retail sales report showing that consumers are still spending. To your point, job market seems to be holding up pretty well. The number of jobs added to the economy has started to cool, and the unemployment rate is over 4%. But yeah, bit of mixed signals there. But generally, our expectation is for 25 to be a little bit cooler than 24. So what I mean by that is we'll probably have a one handle in front of the growth rate. Won't be recessionary territory by any means. I think we have a pretty low odds of a recession, maybe a quarter, 25% odds of a recession, but still slightly cooler, but not too bad. So I'm going to stop there and let Daniel jump in. Thank you.
Great.
Yeah, thanks, Joel. I guess I can talk a little bit, Scott, about what we're seeing in Texas. So that national macro perspective lines up with, that's the take that we have also. But in Texas, we had a really strong start to the year. When we did our forecast last, November, December for 2024, we basically, the headline was 2024 is going to be a sideways year. We thought in a lot of ways it would look like 2023, but Texas came out of the gates, really going and blowing, so the first quarter of the year looked really strong, macro statistics, housing numbers, and then things have really slowed down a lot in the summer. In fact, we went from doing double the U.S. job growth rate to now we're actually pegging a little bit slower job growth. We had a couple of negative employment numbers over the summer. Now, they're not statistically significant month to month, but we're used to posting positive numbers. And the same thing on GDP growth. So we're used to outgrowing the country, but we're growing essentially the same rate as the U.S. That's in large part due to the softness in oil and gas, which is not nearly as important as it was, but we grew at about 3% annualized through the first half of the year. And we would have grown a half percentage point more if we didn't have any oil and gas in Texas. So that industry has actually been a drag on the economy. And professional services have been pretty weak too. So we're not sure that that's going to continue through the end of the year, but it's been a little bit of a surprise that we've softened as much as we have relative to the country.
Great. So given sort of the mixed bag of the picture, there's also been a lot of back and forth about, are we going to have a recession? Are we going to have a soft landing? And you kind of addressed that, but I'm wondering, I want to ask both of you, are there any particular indicators that you watch that would be, sort of an early, indicator to you that we might be headed for a rougher landing? Joel, you want to take that one?
Yeah, sure. Thanks. I'll do that. And I'm going to try to share my screen and hopefully not destroy everything here. But, I think one big aspect of the economy that we're watching really is the consumer. So the consumer is, or at least consumer spending accounts for about, hopefully you can see the chart, about 2/3 of the economic activity in the US. And I think, again, even though we did get a really strong retail sales report, there is still a lot of concern about how this is going to be sustained. So people are certainly still enjoying, I think, some of their 2020, 21 post-COVID savings. I think that's drawn down quite a bit by now, depending on the measure that you look at. But if you look at the charts here, data from the New York Fed showing that consumer credit balances are still growing and are growing at a pretty quick rate. So whether you look at, I think maybe focus on credit card and auto, right? Those levels are pretty high. So yeah, they're spending, but they're also financing a lot of spending. So at one point the bill has to come due. And so I think maybe the counter to that is, well, if the job market is still doing pretty well and wage growth is still there, they can probably pay down some of this debt. But then the red flag to me is if you look at the chart on the right, that 90+ day delinquency number is also coming up, which means that more and more households are falling behind on some of these credit payments. And I think if you decompose some of this even more, it's mostly, it started with the lower income households, younger households, but then you're starting to see some of that creep into the mid-tier, so slightly older borrowers, slightly higher income. So we are seeing, I think, a bit more strains across the consumer sector. And like I said, if this is about 2/3 of the spending in the economy, we're going to see a forced pullback, or maybe not, when people start to realize that that they're spending beyond their means, and maybe the picture is not as great looking out for the next couple of years. So this to me is what I'm looking at for where things might go.
Okay, great, very helpful. And Dr. Oni, how about you? And maybe focus again on Texas. What any indicators that you're watching to see what the economy's doing here?
Sure, Scott. So I'm glad you're recording this because I mean I think we've got a couple of economists that agree with each other. I will share a little bit of data. Now I'm going to stay at the national level for just a second, and this is so if y'all are seeing that.
Yep.
This is a little bit of a different take on some of the same data that Joel was looking at. So this chart on the left, these are year-over-year percent changes in delinquency. So that blue chart, that's a summary chart of that the disaggregated components of consumer debt that Joel was sharing. And so you can see the spikes in this. On the right side, I follow commercial a lot. So I've got general business lending activity and then commercial real estate lending in red. Now, one of the things that all of these indicators, they're showing, when it spikes, what we've seen recently, we're already in a recession historically. So there can always be a false positive. But the challenge with dating recessions is you could have the NBER, which they come out and say when we had one. They may come out in the spring and say, yeah, we were in a recession last summer or last fall, and the country's actually come out of it. So that's something I have been paying attention to. I do agree that consumers, there was more gas in the tank for the economy this year because of federal stimulus and that growth in savings. But in Texas, like I said, the metrics I've already shared are the things that are most concerning. That we've just seen slowing job growth, a little bit slower migration into Texas, and I think part of that has to do with affordability. That we're not as competitive on housing costs and other costs as we used to be.
Great. Thanks for that. So Joel mentioned earlier, that we got the Fed cut, the nice 50 basis point cut that everybody was hoping for and talking about all summer, it seemed like. And then rates have been going up since then. So a couple of things. What do you see in terms of the remaining Fed cuts for the rest of this year and next year, and will that drive down overall rates, mortgage rates over time? Just curious what your interest rate forecast looks like.
Yeah, sure. I can jump in. I guess for this I could pull up any one of 5 slides, but I'm not going to. Maybe start with where the Fed thinks they're going to go. So this is always sort of a fun one because it's, the sort of the bad joke is they're forecasting what they're going to eat for dinner tonight, right? So this is going to depend on what conditions they see between now and dinner time. Sorry, again, that's sort of a bad illustration, but in any case, what you're seeing is a chart of the economic projections that they put out at the last meeting. So this is just sort of straight down the middle, the median. And so we're kind of going with that right now. We agree that the concern has shifted from inflation to the health of the job market, or really the unemployment rate. So whether you look at the projections, sort of the rate projections in conjunction with the change in their expectations for the unemployment rate, or you listen to Powell's comments after, I think that justification that inflation seems to be on a sustained downward path. So we can now turn to making sure that we don't manufacture some kind of hard landing. So, 2 more rate cuts this year, I think, is the median, and 4 next year, getting us to about a 3.5% longer run rate seems to be reasonable, again, given the data that we're seeing now. I think one notable point there is just the dispersion, I think, around the longer term rate. So you have some disagreement there as to whether the longer term rate should be 2.5% or 3.5%. I think 3.5% seems about right, but really the impact there is, yes, there is some maybe medium-term uncertainty, but I think for the next 12 months or so, markets are mostly sort of pricing in this move and again, hoping that there are no upside surprises to inflation. So I think a lot of the rate declines that we saw in what is it, July, August leading up to the rate cut were sort of already priced in. Mortgage rate, sorry. So mortgage rate movements were already priced in leading up to September the September 18th meeting. So to your point, rates have come up since then. It's because the data have come in stronger. So I think there is a little bit maybe of nervousness that things might not go according to plan from here on out. But our longer term forecast is for rates to come back down into the low six. Well, it's in the low sixes. Actually, no, it's about 6.5 today. Maybe lower sixes early next year and getting into the fives next year. Again, if things sort of play out the way they've come in so far. So again, inflation's getting a little bit softer, job market's getting a little bit softer, and if economic activity does continue to slow. So I think getting to that high fives is a possibility by end of next year. No pun intended.
Okay. Dr. Oni, do you agree with all that?
No, I don't agree with all of it, but I think it's a pretty reasoned assessment. We're trying to do the same thing in terms of predicting where these interest rates are going, and it's always good to remind people that the Fed funds rate is one interest rate, and there are markets for all of these other interest rates. So you can see the participants in those markets, they have their own ideas about the value of that money, and so there can be a slower response when something's going on. I'm personally a little bit more maybe pessimistic about inflation. Powell did say in his last remarks that he felt that they were equal risk. The employment side and the inflation side, and that had switched from the previous announcement where he felt like, okay, we're bringing the job number back into view. We've only been focusing on inflation for a long time, so at least he thinks that they're where they need to be. They probably are. We had seen some strength in some of the producer prices. We follow construction costs and all, and those went up a lot. They didn't really pull back much, and it looked like we were going to get some relief. And again, the story earlier in the year looked a little bit different than what we were seeing going into the summer. So again, the disconnect between Fed funds and those other interest rates, what are the expectations in terms of government spending? And in terms of what kind of interest rate are we going to need to finance ongoing deficit spending? So markets could expect, could want a little bit higher return than maybe we would like. So that's probably the only difference from where I sit. And it's not material really, but it's just maybe I see a little more risk for higher rates.
Yeah. If I could just kind of so first of all, Dan, I will agree that the budget deficit is going to put upward pressure on rates in general. So I think that certainly is a factor, whether we think of a higher long run rate or just upward pressure on where things might go. I think the other thing that I would throw in here is that spread between the 30-year fixed and the 10-year Treasury, that is still wide relative to historical levels. So right now, I think we're looking at about a 230 basis point spread. Typically, that's about 180 bips. At the peak of sort of that spread blowing out when the Fed jumped in and started to tighten, that went up to about 300 basis points. And I think one of the biggest drivers there obviously was uncertainty. The other was that they were the largest mortgage-backed securities purchaser in the market at the time, probably still are. And as they've pulled back, we haven't seen any other investors step in to the same degree, whether conditions are good or not. And I mean, this basically is what Daniel's saying, maybe taking it a little bit further. But I think we're not going to see that spread get back to 180 anytime soon. So I think that is really going to play a lot in terms of how mortgage rates go, at least less so treasuries. But just wanted to throw that back in there since it's kind of important for mortgage rates.
Yeah. I had a question that I was going to ask also about inflation. You both kind of touched on that. I mean, so that's obviously been the big driver of interest rates over the last few years. Daniel, you said you were a little bit less optimistic about that. I mean, what is your kind of inflation forecast? And, given a lot of the campaign promises that we're hearing and different people saying, they're going to increase in inflation because of this or that. I mean, what do you see there? What are some of the risks?
Well, I think part of it has to do with, we're seeing for good or bad, maybe a little bit less pressure internationally on prices. But we do follow oil and gas a bit. It isn't as important in the Texas economy, but we've seen depression in the oil market. Gasoline prices seem like they're unnaturally low. I won't speculate on why. Market participants have maybe driven those prices down a little bit, but that's usually a harbinger of general inflation. We just expect those, given where the economy is right now, those should be a little bit higher. And so some of that, again, not speculating why there's certain activity in certain markets, but once you get through an important political cycle, some things might change. I think the other thing is there's perspective or perception versus what the numbers, how they print. A lot of people really don't feel like inflation, has improved, and that's largely because we haven't seen a lot of prices come down. And so I think that the general mood of the country is pessimistic. That can feed into, how things play out long term. So inflation expectations among economists are often different than the expectations among average households.
Great. Joel, from the MBA's perspective, how much do interest rates need to come down before we start seeing any meaningful refinance activity? Is it a lot lower than people think?
Yeah, that's a great question. Clearly the biggest one for the industry right now. I think it's tricky. I think everyone wants that magic number. If I just plug it into my forecast model, I will say that something below 5 would get the biggest response from a model perspective. And we run these scenarios all the time. But I think what we saw over the last month or so was an outsized reaction to rates getting from 7 to the low 6s. And so I think it maybe became less of a magic number discussion. It became more of a trade-off. The trade-off between a 7% rate and a 6% rate, right, was a lot higher. Well, giving up your 3 or 4% mortgage rate, going to a 7 or 8, clearly is not ideal, but maybe that 6% number made things a little bit more palatable for some households. And if you break it down by the different loan types, FHA and VA rates actually went into the 5s. The VA rate, I think, went as low as 5.5 or so on average. So you certainly had some activity there. I think I'll probably just throw up a chart here that I've stolen from ICE, showing the distribution of rates, at least recent vintages that are out there. So a lot of what we saw, like I said, over the last 4 to 6 weeks, maybe more than that, were recently originated mortgages with rates over 5.5%, who decided to refinance for various reasons. Like I said, some of these might have been FHA, VA borrowers who got to a point where it was beneficial for them. And then on the right, you kind of see they give you this broader look where, where would the impact, or where might the impact be, if rates got to certain levels. So I think that's one nice way to think about it. I will say that I'm pretty sure the chart on the right does take into account a 75 basis point cushion. So that means, you'd have to have more than a 75 basis point sort of rate advantage for someone to actually refi. So again, that is also dependent on, I don't know, consumer psychology, right? Because again, someone with a higher loan size might say a 50 basis point incentive is enough for me because of the dollar impact. Whereas someone with a much lower loan size might say, no, I need 100 or 125 basis points to actually act because I have a small loan amount. And obviously it doesn't take into account how seasoned the loan is or how long they have till payoff. So if I'm more than halfway through, a 15-year or a 30-year fixed, may not want to refi, just given that I'm closer to payoff than I am, if I were to extend the term for payments. But and again, I can talk about this all day, but I won't. I think part of this, is also then factoring in the whole cash out refi scene. So we talked about consumer credit starting to snowball. Some people have to cash out because of life reasons. And we know that the cash out share is still pretty high. Again, it's not about getting to a 5% rate to give up their 3% to cash out. It might just be they have to do it, and a 6% rate is better than a 7% rate. So the long-winded answer to your question is I don't know that there is sort of a magic number, but we've certainly started to see more than we expected on the refi side.
Yeah, great. Thanks for the perspective on that. So we've talked about rates, we've talked about inflation a little bit, and both of those play into the cost of housing or the affordability issue. So really want to get into this a little bit more. You know, Fannie and Freddie obviously have a mandate to try to help with this. You know, the different government entities are involved in different ways. What else can be done to help, or can the government help in this regard? Daniel, I'll start with you on your thoughts on affordability.
Yes, thanks, Scott. So I mean, it is a huge challenge. I mean, we've seen in Texas, we've seen actually, if you adjust for incomes, and if you use that old rule of thumb of, you know, the median home price to median household income, it's not perfect, but it's something you can easily compare across markets. You know, 20 years ago, most big Texas markets, that was about 2.5 or so. You know, the home prices were about 2.5 times household income, and even at the height of interest rates, say in 1980, when we had the peak in mortgage rates, that number nationally was only about 3.5. You know, so even at much lower interest rates today, homes are so much more expensive. And every Texas market today, that multiplier of multiple of house price to income is about 5. So it's just much more difficult for anyone to get into a house than it used to be. I like to look at maybe the interaction between rental and excuse me, that rent buy decision. You know, the last 5 years in Texas, we've seen median home prices go up, you know, 40%. We've seen single family rentals go up 30%. You know, apartment rates are only up about 19, 16, 17%, something like that. So it's definitely become more expensive in that for sale product. And in terms of that decision, largely because of overbuilding in multifamily, but we haven't seen the increases there, and so you're probably going to see a little bit more softening even in the single family rental markets, at least because there's so many great apartments at cheap rates right now.
Yeah. I was gonna getting a little ahead of myself, but yeah, I see a lot of multifamily new construction where I live outside of Dallas, and would certainly think that would keep a lid on the rent increases and play into that, you know, buy versus rent decision.
Well, I might share one slide, and just looking at that new construction piece. So this is looking at 3 price cohorts. These are new starts in Texas. So if we look at homes under 300,000, then the 300 to 500 and the 500 plus. So that 300,000 and under, which we would have talked about maybe, you know, middle class, affordable home, it was, you know, 90% of the housing starts back 10 years ago. And it tracked down slowly to about half the starts right before COVID. And then you just saw it fall off a cliff. So it got down to only 13% of starts in the state for a while. It's ticked back up a little bit, but you have just seen an increase in the price of homes. Now, a lot of this has to do with a 43% increase in construction material and labor costs, but also builders maybe went to a little bit larger home size, trying to accommodate more home offices, things like that. But you know, the new home market really affects home prices at the margin disproportionately. And new homes now in Texas are about 20% to 25% of all transactions. So that's 3 times what it was 5 years ago.
Okay, so thanks for that. Let me pivot over to Joel and ask if you have any additional comments. And then I know that you wanted to also talk about with regard to affordability, you know, the impact that we're having from the insurance premium increases. So,
thanks, Scott. Yeah, you know, just to piggyback on Daniel's comment and the chart, from a national builder perspective, and I know I don't work for the home builders, but we do have a pretty big group of public, I guess, lender affiliates of public builders, and in talking to them, you know, I think a lot of what we see in the earnings reports, they do want to build in the entry level, but the same kinds of obstacles have been prevalent. And so what I mean by that is the lumber lots. I think Rob Dietz at the NHB likes to call it the 4 Ls or 5 Ls, depending on the day. But you got lumber, lots, laws, lending, and labor. So all these different Ls are causing issues for the industry at a national level, obviously also at a local level. So I think the large home builders have been able to put stuff out there because they have the pricing power, just leave it at that, and they have the contracts in place, so they're not as vulnerable to some of these price shocks, but then also they can offer buy downs and other concessions to compete and to actually get borrowers to come in. And so yes, that's kind of helping a little bit, but at the same time, I think that's still not enough to really help the overall affordability problem that we're having here. I think that the underbuilding was really post great financial crisis because of what happened there, and we just haven't really recovered from that for other reasons. So we just don't have as much speculative building, which is what got us into the mess. But at the same time, I think it's also prevented some of that stock from recovering as quickly as it would have in other cycles. So I'll leave it at that. But yeah, thanks.
Yeah. What about your comments that you made to me earlier about the cost of insurance and how that's playing into all that?
Yeah, so where do I start? I mean, the insurance discussion has come up. We started to hear it from the originator perspective, where you have a borrower coming in more focused on the down payment and being able to afford the principal and interest, and then getting to a point where they realize that the homeowner's insurance piece was just massive, or in some cases just not available, at least not at the terms that they wanted it. So that caused some transactions to fail, which clearly is not good. And then now we're hearing more of that on the servicing side, or really just on the cost of home ownership. So you're hearing about borrowers who did qualify for the mortgage initially, but then whether they have, and I think this is more this case for fixed and lower income borrowers who just can't afford that payment shock when they go in for a renewal, and they get a much higher homeowners insurance bill than they thought they were than they were used to. I mean, in a nutshell, and I'm trying to find the slide. In a nutshell, what we talked about was homeowners insurance used to be sort of a set and forget type thing that you did when you got the house, and you would renegotiate it every few years to make sure that your policy was updated and you got the best rate you could get. But now it's become such a big variable cost for so many households that it is a much bigger part of the discussion in terms of maintaining that home ownership, right? So we focus a lot on the affordable side, just getting people in. But then after that, you got to make sure that you can keep the borrowers in, and making sure they're not delinquent on their loans. So on the servicer side, we can take that discussion down a different rabbit hole, just talking about servicers needing to make sure the borrowers are adequately covered, deductibles are within guidelines, et cetera. And I know I've already kind of rattled on, but I just really quickly will show this chart because I want to make a quick sort of plug for the most recent mortgage market monitor from ICE, where they had a really nice deep dive into the impact of taxes and insurance, along with principal and interest as well. But I thought this one was really eye-opening. So I think a lot of us have already seen, and actually before I show this one, maybe so a lot of us have seen this one. This is from CoreLogic. So I'm jumping between my industry friends here. CoreLogic showing where the premium changes were most acute between 21 and 23. So maybe we'll share these with you all later so you can see where the biggest increases were. Texas in the top 5 there, unfortunately, for the wrong reasons. But you can see, where the hot spots were in terms of where property insurance payments or affordability has impacted. And then, again, the ICE data did show that a lot of the recent mortgages that were originated, most of that payment shock was actually in principal and interest because of how quickly rates came up, which does make sense. But again, this one I thought was notable, just given the share of the average payment that goes to taxes and insurance. And I know we're talking about insurance here, I haven't really talked about taxes, but I'll leave that. Just, again, just the outsized impact of insurance costs is going to be with us for a while, just given that we're only seeing the start of this. The insurance industry usually needs about 2 years or so to ramp up some of these premium increases because it's highly regulated. But in any case, this is going to be something that we have to look out for in the coming years.
Scott, we have an attendee question on homeowners insurance. The question is, do you think the huge increase in homeowners insurance and property tax is directing more buyers toward renting?
Dr. Oney, let's go back to you because that kind of dovetails with what you were talking about earlier, and love to hear some of your thoughts about the insurance issue as it pertains specifically to Texas as well.
Sure. Yeah, I think the short answer to the question is, yeah, that's got to be having at least a marginal, probably more than a marginal impact. As I said, when you compare rental rates, incomes in Texas have been keeping up with rents, but they're not keeping up with home prices. And so the numbers, Joel's numbers were right. We agree with that, and maybe a little bit worse. If you look over the last 5 years, Texas has had the fastest increase in insurance rates of any state. We're not the most expensive. Florida is still, a little more than double what the home price, the cost of insuring a home is. But I think we're fourth now in the country in terms of absolute rates. So it is having an impact on home buying.
Thank you. I want to circle back to my original part of my question. Vice President Harris, I know, has proposed some sort of a $25,000 credit. I don't know exactly if that's a tax credit or what exactly that is. But again, going back to what can the government do to help this situation, and when I say the government, I include Fannie and Freddie in that. I mean, are there other things that they can be doing to help that you see out there, or what's your take on that, Daniel?
I thought we had dodged that one, so you're going to bring us back to it. No, it's tough. I mean, I like the 4 L's or the 5 L's. The regulations on housing is really an important one, and I'd probably focus on Texas more. I mean, we have seen the state legislature get more involved in this. So Texas communities, in many cases, you see a little bit more NIMBYism. You see a little bit more of a concern about the rapid pace of growth we've had in Texas and how that's impacted affordability and quality of life in some of our cities. And so the legislature this last session did put into place a few bills to try to address it. Of course, property tax reform was something that's typically what Texas politicians will point to as the number one thing they can do to address affordability is to try to help on the property tax side. We do have relatively high property taxes in Texas compared to other states. But then also the legislature has shown a willingness to get involved in local regulations. So you have bills, for instance, allowing, and it's not actually worked all the way through. We're not sure how it's going to come out in court cases, but where builders or homeowners have the option of going to third-party certification for building plans if the local government doesn't actually meet their posted deadline for approvals. So some things like that a little unusual. We might not have expected to see that, but I think it's something that Texas policymakers are really concerned about. And it's going to be probably an even bigger issue in the next session, even though prices are down a little bit. It's just the overall pinch on consumers and households that, again, it's the perception. People are perceiving a lot of constraints, and just their money doesn't go as far.
Gotcha.
Yeah, and I too echo that. I kind of was hoping to dodge this, but since we're going down that road, I guess I'll just throw in my 2 cents. But from starting
you
from
are
a
over
high
there
level,
by the Beltway, right? So
right.
you got proximity going for you.
Well, this is a small group that I can trust, right? Hopefully. So anyway, going back to sort of the high level view, we had a first time homebuyer credit back in what, '09 or so, and all that did was it pulled forward a lot of demand, and so you got people trying to beat that deadline, get that tax credit, but it didn't really help, I think, the overall affordability picture because, if you're selling a house and this credit is online, you just raise your price, right? So, I mean, I'm oversimplifying, but that's how it works generally. So if they're going to do that, they would need that sort of counterbalance, and I think that's partly what Daniel's getting at too, is just you have to boost supply to some degree, maybe a higher degree, just given that affordability is already a problem, so you can't make it worse. So if you're going to give tax credits, you need to expand supply to kind of more than offset the boost on the demand side. So, you know, just to give you sort of a local anecdote, I'm in Northern Virginia, and there are, I guess, local councils. I'll leave it vague, who could allow more new building or really just a repurposed zoning type ordinance where you allow a single family home to be torn down and you allow 4 townhouses or smaller units, whatever, built. But people would rather see a boarded up house with an overgrown yard than a multi-unit property close to their house. So again, that's very, very specific, but I think you still have a lot of the NIMBYism going on, even though you might get a federal, right, sort of move to try to expand supply. So anyway, I'll stop there because yeah,
That's good. So you talked a little bit about supply and demand, and that is actually something that I'm interested in. We hear a lot about the lack of inventory, or in certain parts of the country, lack of new building, new construction. But I'm wondering if you have any thoughts on sort of the demand side. I mean, we're hearing a lot about these demographic changes where, we got an aging population, we have a declining birth rate, we have people that are moving from some states into other states. A lot of uncertainty about what immigration levels are going to look like after the election, perhaps. So with those sort of drains or potential drains on population growth, I mean, does the demand side of the equation become just as important as the supply side that we hear so much about? And are there kind of disparities or disconnects in the equilibrium where certain pockets of the country have too much supply and others don't have enough? Or I don't know. What are your thoughts on that?
yeah, I think so. I mean, if you look at the demographic distribution, so again, we can drill down, but you have a good number. So if you pick a range from, I think it's 25 to not 25, it's like 30 to 40 years old, I think is the range, right? You have about 50 million or so people, sorry, who need a place to live. So I think the demographic drivers from the younger cohorts are there. The problem is we don't have the entry-level starter homes for that population. And if you think about the older generations that are downsizing, they're not selling townhouses or condos. They're selling 4, 5, 6 bedroom mansions that a first-time homebuyer just can't live in for many reasons. And then immigration, I think if we're talking about new immigration, lots of new migrants don't buy off the bat. I think you have usually at least a generation of renting first. Yes, you have some cash buyers, but I think that's still a very small share. And the CBO put out a report early this year that, unfortunately for us, we're not capturing the exact level of immigration that well to begin with. So, but all that to say is we acknowledge that there probably are more immigrants than we know of, and that's part of the problem. But for housing demand, that is. But I think the exact measurement is still kind of fuzzy at this point. So go ahead, Daniel. I think you've been trying to say something.
I'm just maybe I'm fidgeting a little bit. No, I agree with what you were saying. I can just bring a little color to the Texas perspective. I mean, we're still adding people, every way you can do it. We make more than we lose through death. We import more people from abroad or from other states, to a greater degree than we send people away. So we are growing, but our household structure and our demographic structure is changing. So if Texas had the same demographic structure today that it did back in 2000, we'd have 300,000 more of those traditional households, the parents with kids. So you think we only sell about 350,000 homes a year in Texas. So that those people that are not here that would have been, theoretically, if we looked like we did a generation ago, that's a big impact on the housing market. At the same time, we've got a couple of 100,000 more of those single person households. This goes exactly to what Joel was saying, is that the product mix may not be aligned with what the new demographic reality is. And then a lot of it goes back to those regulations. As he said, many local governments, they want to see a single type of product delivered. Even in pro-growth communities in Texas, there's often less enthusiasm for multifamily, let alone things like a duplex or a fourplex. So the demand side is important, but I probably come down on supply being a bigger challenge. I think we need more diversity of housing, and we probably need more density in some communities before we can really address affordability.
Great.
And I'd throw in I don't think I have an answer for this one, but I think the hybrid remote work initially looked like it would help us solve some of that problem, but I don't think it did. I think it ended up unbalancing or making the imbalance worse for some of the more rural areas or some of the smaller states, because people thought they could move there and then work in New York City or Boston or wherever. And that Boise, Idaho was the poster child for that, right? So you drove up prices 35% at one point in Boise, Idaho, because everyone from Seattle and Portland and California moved there. So that doesn't, I mean, we've reversed a lot of that now, I think, but that's still very much a part of the discussion, because if we have, I don't know what the share is, let's say a third of the workforce is still able to work remotely, does that help us ease some of the supply problem where they can work or live a little bit further away? I don't know. I mean, just throwing that out there. I don't know if Daniel, you have any thoughts on that, because that's an ongoing discussion. I know some managers here are kind of rolling their eyes too, because they're dealing with return to office policies. But anyway.
Yeah, that is important. In Texas, so much of our growth has been in the big four markets. 80%, 86% of all our population growth has been in the four big metro areas since 2010. We've got 25 metropolitan areas in Texas. Those 21 others only get about 12% of the growth. And we've got 174 counties in Texas that only earned about 1% of all the growth we've seen. So I think if we could find ways for our smaller communities to be more competitive, to be more accommodating to growth, that would take some pressure off the bigger markets. So I think the location and the mismatch of jobs and in housing and where people want to live is part of the answer.
Okay. Yeah, thanks for that. This is sort of my last question, and Daniel, you touched on it, I think, at the very beginning. The Texas economy, in the last several decades, it seems like, has been seen as much more resilient, much stronger than the national economy as a whole. And I'm just wondering if you could talk a little bit more about, the softening that you mentioned earlier, and if there are areas where maybe we have blinders or feel too confident about our resiliency, and we need to be more on the lookout for things that could hurt the Texas economy.
Sure. I mean, one of the things that I talk to audiences about a lot is long-term growth trends. And I like to use, not to pick on other states, but I like to use California as kind of a cautionary tale for Texas. I tell audiences, if you look at trends, you could almost imagine Texas is where today where California was maybe in the 1950s. So there had been a lot of investment in California in infrastructure, water, roads, perhaps the world's greatest higher education system. And then in a lot of ways, the state kind of stopped investing in itself, and it reaped a huge amount of growth since then. But now you've seen, California is no longer the place where you would go to start a business, to go raise a family. It's Florida, Texas, Tennessee, other states like that have kind of inherited that mantle. So not everybody in Texas wants to keep growing, especially as fast as we have. There's a lot of concern about those costs of growth. But I'm also afraid that if we don't stay focused on accommodating growth, through continued investments in things like water, like power, like our transportation systems, then a lot of that growth is going to show up anyway, and we're going to pay for it in terms of those congestion and affordability costs. So that's mainly where my thoughts are these days. It's not the cyclical issues. Texas has an incredibly diverse economy. All of our cities have very different industry focuses that complement each other. So I'm pretty bullish about the overall, future prosperity of the state. But we are going to have to keep paying for it, I think, one way or the other, if we're going to grow.
Are there any particular danger signs that you see out there that you're keeping an eye on? I know you already talked about the consumer stuff, but I mean,
not
any
things that are
threats?
not things that are short term, cyclical. Like I said, we're just seeing, in terms of residential markets, we've just seen a pretty big pullback. If you track where we are month to month, we were running at last year's rate, or actually about at the historical rate until the summer, and now we're actually the last few months we've been running at sort of historic lows in terms of monthly sales. So I think that just reflects one thing. I talk to a lot of realtor audiences and other people, and they say many people are sitting on the fence. Maybe they're concerned about what the outcome of the election will be, or other geopolitical issues. So I think there's just a lot of maybe demand being pent up, and we'll see some of that once we get through, this political cycle. It'll show up again, but no, I don't see anything that is like a super dangerous red light flashing at this point.
Joel, I'm going to give you the last question here, and Dr. Oni teed it up great for me. So with the election coming up just in a few weeks here, and maybe that'll solve our supply problem when people like decide to leave the country when their candidate doesn't win. I don't know, but anything you see risk wise or big change wise economically as a result of one outcome or another?
Yeah, I'm gonna go back to something else real quick, not to deflect, but
Sorry.
the one thing that actually I've been thinking about when we talked about housing supply, and I know locally it's really different from a builder perspective or building perspective, and that's the lack of tradesmen. So I just saw lots of, well, not lots, I'm seeing lots of headlines on just the lack of plumbers and carpenters and electricians, and I know that's contributing to some of the higher building costs, but also just the lack of availability getting done. And what I mean by that is the large builders, like I said, they have their crews and they're ready to go sometimes, but then you get to a point where your builder is too small to have a regular crew, and they want to do this rebuild or renovation or whatever, and they can't. They're just sitting there waiting for either materials or people, right? Or they just can't afford to go through with it. So I'm wondering if, from a local, right, as the more you drill down, I think that's going to be a problem, for lots of markets. So maybe I don't know how bad it is in Texas, but I certainly see it here in Northern Virginia. Just you're waiting for the carpenter crew because he's got like 12 other jobs to do this week to get something done. So anyway,
That's a great point.
So back to your question, I mean, I think from a macro perspective, I think there are similar risks to both candidates. I mean, I think the biggest one that I worry about really is the budget deficit overall. I think either way you go, I think we're going to run the deficit up. So if you have a Harris administration, and I am not going to speculate on the House and Senate, but I think it's status quo. I think you're going to have more of the same, and some of the spending plans are going to be sizable. And I think, if you have a Trump administration, the tariffs and the spending do worry me, or the spending plans, or maybe the lack thereof, I don't know, might worry me a little bit. So I think that to me is a downside, and specifically, if there is uncertainty around tariffs and a trade war, I mean, there usually are longer term impacts, but also shorter term, just unsettling, companies trying to get ahead of potentially an inventory buildup because tariffs are coming down the road and they want to load up on things. So I know I'm kind of rambling a little, but I think, yeah, at this point, I'm glad they're both talking about housing. Let's focus on the positive. I'm glad they're both talking about housing. I think they both recognize that we have a supply issue. So that's what I'm looking forward to. But I think on the trade policy side and on the government spending side, I don't know that it's going to be a good 4 years either way, personally.
Yeah, well, I'll tip my hand. I'm rooting for a split decision so that no one party has complete control and can get anything done. So that may be very cynical of me, but
that's usually helpful for the mortgage industry.
Yeah, that's what we're all about here.
Yeah.
So, all right, well, great. Well, Stephen, that's all the questions I have. So unless there are questions from the audience or either Daniel or Joel have any additional comments to add, anything we missed?
Thank you. We have a few minutes left. Here's one more question that would be interesting. With increasing economic uncertainty, how important is innovation in the mortgage lending industry? What new technologies or strategies should lenders adopt to navigate both the current economic environment and prepare for future market shifts? Thoughts on that?
Fantastic question. So if we had another hour, I could certainly go into more of that, but we have been seeing clearly a push towards more technology because of this day and age and because mortgage has been so far behind technologically in general, but also we came off of 22 and 23, which were just dreadful years for origination. So people were trying to lean out their operations. They had the time and maybe a little bit of money to try to get things more efficient. But then we also got to a point where we realized that this is still the biggest financial decision someone's going to make. So you need to have all the shiny, cool new technology. But then if someone calls, you need to pick the phone up too. So it's great, I think, from a developmental sort of technologically, I guess, advancing perspective. But at the same time, I don't know that the cost benefits have been there yet. I think the quality is improved, but I think the ROI hasn't quite proven to be as what we thought it might be. But maybe that's something that we'll see in a higher volume environment where you don't have as big of a capacity adjustment because you have the technology tools. But another quick point on AI that's come up a lot. I think the AI deployment has shown itself in many different ways. I think one of the biggest impediments, or really the two biggest, one is just the uncertainty. You don't want to get too far ahead because that is changing so quickly. And also just everyone is in a different place. And so you may or may not recognize the same sort of gains in productivity that someone else is seeing. And then I think the second big one is so I would put cybersecurity in the first bucket too, uncertainty. The second big one is regulation. I think lots of states are trying to move ahead of any federal regulation because there is no federal regulation. And what I mean by that is regulation on data privacy, cybersecurity, et cetera, when it comes to AI, in a financial services setting. So I think the regulators right now haven't done a great job of even defining what AI is and where it might impact the originations process, since it's a mortgage group. So there have been some bills that have been struck, and MBA has been pretty active in that, in helping these, because the way that some of these bills are worded, or AI has been defined as, you could effectively have someone opt out of an automated underwriting decision or even a credit scoring model, again, by way of definition. So there needs to be a proper definition plus carve-outs, I think, for mortgage, if that makes sense. So I think, and actually, I think Texas is on our list of priorities, because I believe there is a bill in the works, and I think 2025 is when they will have to make some decision over it. So I don't have all the details, but if you're working in that space, let me know. I can put you in touch with my colleagues. But yeah, AI regulation at the state level is a big deal right now.
Great. Thank you, Joel. Scott, Dr. Oni, any thoughts on that one before we wrap up?
I don't have anything else. I've really enjoyed visiting with you guys and really, really appreciate the conversation. I thought it was really great.
No, glad to be here.
Great. Well, thank you, Scott and Joel and Dr. Oni, for taking time to share your knowledge and experience with us. Thank you all for joining today, and we hope you've learned more and enjoyed the presentation. TMBA continues to bring you great webinars like this one. Please visit the homepage at texasmba.org for upcoming webinars and previous webinar recordings. Thanks again, everyone, and that concludes our webinar.
Thanks, Stephen.
Thank you.
Have a great day.